Ladies and gentlemen, welcome to our program on IBM TV, Modern Investing. My name is Sasha Star, and I would like to introduce my uh, esteemed guests on this program. We'll start with Peter Bennett, who is graduated from New York University and is a stock professional coming from Wall Street. Thank you, Peter, for coming to joining us. Nick Palideda, who is the founder of this network and is investor in all kind of stocks, the dividend stock, risky stocks, and even bankruptcy stocks. And he's very successful at all that. And the new fresh blood in our program is Mariusz Skopiniecki, who is his website is the microcap stocks, and I think that was something that we were missing in our last programs, is because we talk a lot about high yielding dividend stocks, but they're mostly well established, quite expensive stocks, but it's, in any case, it should be a core of any investment portfolio. We're talking about options, primarily options writing, calls and puts, because that's where the money is. And by the way, I've looked more into Gabelli funds. I got another piece of literature from them. They do have couple of funds that do nothing but writing options, writing calls and puts. Okay, and they're generating, after all expenses and their fees and everything else, they're still generating 7-8% dividend. So in fact, they're much more profitable than that, but of course they have expenses. And finally, we were talking about occasionally about crypto, Bitcoin and all this wonderful stuff, gold as a potential, or precious metals, silver, for example. But we haven't talked much about microcap stocks. The reason is that if you consider your core investment, high-yielding dividend stocks, options on the income side, I have a spot in my heart for microcap stocks, and my first serious money actually I made in Vancouver traded stock, which I did very well with. So, and later on, I have a couple more interesting ideas and implemented them quite successfully. So, but lately, last, I would say, probably 10 years, I haven't even looked at that area at all. So maybe now is the time, with the help of Mariusz, to take a look at what's happening to the microcap stocks. What can you tell us interesting?
But before we go there, what's your website address, Marius?
Microcapexplosions.com.
Microcap Explosions?
Yes.
So we are going to talk about microcap and explosions as well.
Explosions with an S.com?
Yes. Yes.
Not that I would.
Okay, Mariusz, please tell us something interesting.
Okay, so I mean, microcap stocks, small capitalization companies that are trading on secondary exchanges, OTC, Canadian Stock Exchange, TSX Venture, or AMN in London. There's only one reason why it's misspelled: microcap explosions. By the way.
Oh. Okay.
So why do you go? Why do you even care? Why would you want to be interested in something like this? It's simply for the fact that you have barely any competition in that space. And just kind of like when we started talking before we went on the air, the notion of when somebody has $10,000 to their name, it's kind of, the general opinion is that it's hard to do anything with it. And I agree. When you are dealing with the traditional route, the traditional places where everybody else is looking at, I agree. You can't do much with it. But when you are willing to go into places where you don't have much competition, magic can happen. And I am a perfect example of it, where I started in 2009 with $10,000 to my name. I had nothing else. And I turned that into $6 million over a 12-year period, strictly focusing on microcap stocks, areas where I barely have any competition. So it's almost like taking money from children.
Hmm. Okay, that's a good point. So there is no competition. Um, what is the risk reward ratio on this stock? I think in your case it was extremely successful, but normally person who would look into one of these stocks to invest, what would he has to compare it to? What his parameters? What he's working with?
It's really hard to say that because it depends on the company, depends on the story, what you're getting involved in. Uh, let me give you an example of a very successful story that I was involved in. It was a company on TSX Venture, and they had it was kind of like a mining stock. They had an ownership in a copper project in Mexico. And what happened is that about 20 years ago, uh, that project called Santa Tomas Copper Project was sold from a Mexican guy to a crook that was from Arizona. And then that crook took the property into his ownership and never paid the owner. And so that company that I was involved with, Oracle, came into the picture and they said to the Mexican guy, "We will get you your property back. We will fight the legal battle for you. We will pay for all the legal fees. And in return, we will get 50% ownership in this property." And so when I looked at it, they already won the legal battle. They already got him back the property, but it was complicated because the legal battle was in three different jurisdictions. It was in Mexico, U.S., and Bahamas. So they won in Bahamas, but they had to complete the process in Mexico and in the U.S. And what was so unique about the situation is that Oracle, while it was fighting the legal battle, it owned both of the entities that were involved in the legal battle. I mean, I kid you not, it owned both of the entities. And so the legal battle in the US, it was about foreclosing or going through the receivership to gain access and control over that other entity that they were fighting with. And so what I was doing is, the market cap was about $3 million at that time. I knew that the property was worth about 500 million because it wasn't some kind of property that nobody ever heard of. It was literally talked about in the geological books for students in the universities. But what I was doing is I was buying the legal documents directly from the courthouse as they were being filed. It was an Arizona courthouse, and I knew more about the legal situation than the management. I was getting the information faster than the management. And all the time I was like, why aren't other people looking at this? It's such a no-brainer. And I was told that hedge funds are not going to get involved, financial advisors are not going to get involved because they don't get involved in the legal mess, because legal was simply turning them off. And I didn't even have a background in legal activities, and it was so obvious to me that they were going to win because the other party was like a car mechanic and a nurse with no money. They didn't have any case. They committed fraud. And anytime they said something, the judge just slapped them on the wrist and said, "No, you're wrong." And I was like the only one looking at it. So um, it turned out to be that, of course, I was right. And then the long story short, the company went from like a 3 million market cap to 500 million, where it's sitting today. And it's just an example of incredible inefficiency was possible on a secondary exchange simply because everybody was refusing to look at it. But it's hard to answer your question like what's the risk and reward because it's so individualistic. I have to look at each stories, and then I can be like, okay, what can I make based on those stories?
Marius, I
So
have a bunch of questions. First of all, how many positions do you take a year typically that you either take personally or recommend?
You mean how many times I invest in something?
In
It
other
might.
words, you said you had a very nice growth. You know, you took 10,000 into 6 million. During that period, how many positions a year are you taking? Are you taking, you know, a few, or are you taking, on average? I know
I
you
would say
some
over I would say over this time period of 12 years, I would say 20 to 25 position in total.
per
So
year.
no, the entire time.
That's what I was kind of getting at. So
Yeah.
you're finding just one or two beautiful positions
Yeah.
that are really, very high risk reward ratios, and then you're picking those. And another question is, how many of those 20 to 25 would you say didn't work out,
So
roughly?
I would say about 5 of them turned out to be a complete disasters.
Well, of course, because you're going
Yeah,
such high risk reward. That's
yeah,
a great ratio for that kind
yeah,
of risk.
yeah.
Next question is, do you post on microcap explosions? If I'm saying that right, .com, do you post these recommendations when you find them?
Yes, yes. So that's the whole idea behind microcap explosions is that, I find them, I give a reasons why they are interesting, and we have management come in and help us with the story, because with the smaller names you can actually get the CEO on the phone, where with the bigger names you can't. And also, um, sometimes we inject capital into those companies. So the particular
Oh,
example that I mentioned about the copper project, after they solved the legal problems, we also injected $13 million into that company to take it to the next level. In total, for my group, because I started my group like right in the middle of COVID, we did about 6 private placements for a total of about $25 million between our members. So there's more. It's more than just, hey, this is an idea. Sometimes those ideas need our help, and by injecting capital into them, they might, acquire a company, or they might pay down debt, or they might introduce
right.
another product.
But you
It's
still
almost
do but you're saying you still do put them on your website. In other words, these names, is there a fee to access your website? Is there a
yeah.
user
So
fee?
there's a membership fee of $3,000 per year.
Oh, okay, so it's 3,000 per year. Yeah, it's a great ratio there of success. It's really amazing.
And I would say that the ones that didn't work out were in the mining space. And actually, I have a great video series that I did on my YouTube channel, Why I Hate Mining Stocks, uh, because the period of from like so I started it seriously in 2009, but the period from 2009 to 2012 was fantastic. I got in the bottom. I did my work, but at the same time there was a lot of luck because from 2009 everything went up, and then from 2012 to 2016 I thought that I wouldn't ever catch a break in my life because I was involved in these mining stocks, gold and silver, and I have never seen bigger fuck ups in my life. What I've seen in that space, and I mean, these guys are professionals at destroying capital, and
Yeah.
I mean, I have never seen anything like this
Well, it's
before.
small cap, so you just never really know 100% when you're in small cap because this isn't IBM or Verizon. Not that I say I like IBM, but I'm just saying it isn't a huge company that's monitored as closely. So, but this is where you get the rewards, right? Because you're looking at situations where if they're winners, they're very big winners. And what other industries do you go for besides mining that you've had more success
So,
in?
since then, I will never touch a mining stock
So,
again.
what industries do you mainly focus on?
So I like companies, as Warren Buffett would describe, companies with something, a moat that's protecting them.
Moats are
So
great.
so a moat could be from brand. I like switching costs. I like companies with recurring revenues. Um, so and going back to a little bit of what you were saying about, yes, that smaller companies are riskier, but if I stay away from mining, then I stay away from a terrible business model. So if I'm going now it's totally different for me because now what I want is, if I'm going into that space, I want real companies. I want real companies with real
Sure.
customers, real products, real management, and something that's special about them. And I realized that this space is risky because, and I would say 80 to 90% of the companies that are listed on these exchanges I would never touch, but
Right.
those 10 to 20% of them are interesting, and these are the ones that I focus on. And I will get on the phone, I will call the customers, I will call the suppliers, call the former employees, and I will
Mhm.
get a full story because I
Right.
want
Yeah,
to know.
you're getting
Yeah,
the full story
yeah,
where which is important. But any particular sectors, or is it just that you'll look at anything you find except for mining? Is that what you're saying, or are you
So I
saying
will
certain
I,
sectors that you stay with?
I will stay away from
No, no, stay with what?
uh,
What?
yeah. So I'll look at technology companies,
Oh,
uh,
okay, you like
ser-
tech.
service or SaaS companies, but I'll try to stay away from pot,
Oh, yeah, that's very speculative. Yeah.
pharma, life sciences. I don't have any interest in those speculative things.
Yeah, they're very complex. I know I
Yeah.
stay away from pharma too pretty much, except I have small piece of THQ because it's just, as a part of a general portfolio, it's large pharma companies and stuff, but it's a third of a percent, just to, diversify or whatever. But you're right, it's because you don't know what's going to happen with pharma. It's complex and there's legislation that could affect it, so it's a little risky, and that
I
would
mean,
affect the
yeah.
small stocks. So why get into that when you have another situation you're talking about, maybe where you don't have these complications?
I mean, pharma are just as bad as mining. You
Yeah,
you don't know
it's
what's going
risky.
on. I mean, yeah, you can have a big win, sure, but I would just rather stay away from those.
Yeah, that's very impressive record. I have to actually think about whether I would just join your group, which surprises me, but it's really sounds like an interesting risk reward ratio.
Yeah,
Do,
absolutely.
do you think you could probably make something like a closed-end fund that would follow your
Oh,
investments, and maybe some people would be willing to participate in that?
Yeah, so people have asked me this. I would just I just because of the experience that I had with the mining stocks, and at that time I was managing people's money. I got so bruised and so discouraged to manage other people's money that I would just rather stay with just managing my own money. And if people want to follow me, they can just subscribe to my service and see what I have. But I don't want to take responsibility for other people's
yeah, no,
money.
I don't blame
Yeah,
you because I mean you have then complicated regulations, but also if it's a closed-end fund, these microcaps, if it gets too big, which might get very quickly,
yeah.
then that that defeats the purpose because as these funds grow, they can't especially if you're going microcap, small amount of relative money can move it a lot, and then you can't buy the shares where you wanted it. So
And
no, it
and
makes sense not to do it.
that's absolutely right. You see, that's the whole idea. And I also limit the number of members that I have for that same purpose. You see,
Oh,
we started off microcap explosions. The price was 1,000, then it went to 1,500, and I raised it to 3,000 simply because I don't want more members. Supply and demand, and it's simply because I want all of my members to be able to get their positions. And if, let's say, we do a private placement and we inject capital into a company, I don't want a situation where they can't get their allocation. Uh, so I'm not the kind of service that, oh, let me have 10,000 members. No, because then we have too much money. We can't go after these
right,
ideas.
exactly what I was
Yeah.
saying. Yeah, yeah. The when you do the private placements, what's the minimum you look for people to contribute to it?
Usually it's 10,000 minimum, but
Yeah.
everybody has to be accredited investor in order to participate in that, which means a person has to either make $250,000 per year from a job or have a net worth of about $1 million. And I'm not sure if I'm exactly right on these numbers, but it's
Yeah, no,
around
yeah,
that level.
right. So it wouldn't be for everybody, but certainly for your high net worth clients or moderate worth clients these days.
And in fairness to say, I think it excludes foreign investors like
Yeah,
Canadian.
that's correct. That's correct.
Oh, okay.
I'm aware of it. Yeah.
But you do have openings right now, I'm guessing, at the $3,000 level.
Well, right. I mean, we are exactly at that level where I'm happy with. It's
Right.
stable. It's
Right.
yeah,
Exactly.
yeah, and also the price itself self-selects certain people,
Sure.
and
Absolutely. Yeah,
and
it
and
makes
you
perfect
do
sense.
want that. You do want the highest quality people that the person that's going to pay the price is going to be like, I'm doing it because I don't have the time to go. For example, recently when I found an investment opportunity, I went through every single company on Canadian Stock Exchange, 800 or 700 companies, one by one, no screening, nothing, one by one, and I
Right.
selected 5 of them and ended up buying one. So the
Right.
person that will pay for the service is, hey, I don't have time to go through all these companies. I just, I want to pay you. You find it to me, and then I will still do my own research. But that's what I'm paying for, because nobody else is doing it. Yes, I can go on Twitter, I can go on YouTube, I can go here and there to find
sure,
these ideas, but I can't find the ones that you can find me, because barely anybody else is doing what you're doing, and also the kind of research that you do, which is calling the management, calling the customers, calling the former employees. That's the value that I'm getting.
Yeah,
But
no, it's a lot of digging
Yeah.
into the deep, even deeper than me. And you know what? I could spend a whole week looking for one dividend stock. I could spend 20 hours, 30 hours, 40 hours going through, and I start with the screens maybe, but reading articles, everything. It's so hard to find those opportunities, especially in this market, because the market's generally very high. I mean, it's very, very high. We are not talking it generally now, but I mean, the investors, and this is a general point I want to make. If I want to make one point in the show about the general market this week, the market is between a rock and a hard place, because the Fed is between a rock and the hard place. The Fed has been stimulating the economy tremendously, and and now there's inflation, and inflation is coming. And I have really interesting articles about how energy inflation is going to continue, and rents are going to be going up, and so it's a real squeeze, because on the other side, Medicare is going bankrupt in 2026. So the government is going to owe more money than anybody could imagine. I mean, possibly more money than stocks, bonds, and real estate combined owned in the U.S. And foreign countries are in the same situation. So they need interest rates to be down, but they need interest rates to go up, because they have to control inflation. So
they're stuck. They're stuck.
Yeah, they're totally stuck, and that sticks the investor in the long run, because now with dividends low, with rates of return low. By the way, Goldman Sachs and Vanguard and a few other companies came out this week. They said they expect very flat returns for the next 10 years. I think Vanguard had a plus something. Goldman was saying, I think they were saying like level with the CPI for the next 10 years. So you're not making any more money, because the rate market already got inflated by low rates. So it's a very tricky situation for everybody. But I like the fact of what you're saying about the work, because you're even digging deeper than I do, because I rarely would call a company. And certainly you're reaching these people much easier than I would. If I call investor relations, sometimes they never even call me back. But
I will say one thing too about, let's say if you wanted to do this, with companies listed on New York Stock Exchange or NASDAQ, you would be wasting your efforts, because 60 analysts are covering these companies. Okay, so what is it that you're going to find out about them that others won't, right? And when you're dealing with smaller companies, I might be the only guy calling them, right?
No, it's a huge advantage for you.
Yeah.
You start with a big advantage, but I
Yeah.
find my ways. There are all kind of niches out there that sometimes, because the big boys don't get into.
Of course.
Certain MLPs, certain Canadian companies, that even own U.S. property or assets, and those are not always in the market. Doesn't notice certain things, but your niche sounds fabulous. It really sounds great.
Mhm. Okay, now let's have a short commercial, and we will continue right after this. Thank you.
Thanks. Were we in commercial?
I hope it will come, but we'll wait for 5 more seconds.
Okay.
5,
I don't think the commercial.
4, 3, 2, 1. Commercial is done. So now we can continue.
Okay, that was a short commercial, but it was fun.
Short commercial, yeah. The commercial was about my other programs that I have. It's a chess program. So we just had recently completed World Championship match, which was one of the most one-sided events in history. But that's another story. Okay, so let's continue on with now in your microcap strategy. Of course, you are not employing things like options, whether writing or purchasing options, or for example, dividends, not evident there. So this is all different again. So basically, if I would right now, my portfolio, my personal portfolio, I have high-paying dividend stocks. It's the core of portfolio, and I have trading opportunities, including options writing or a short-term period hold for mostly non-dividend paying stocks, but it's basically trading idea. And sometimes you can be right, sometimes you can be wrong, like in everywhere. I'm trying to be more right because I believe preservation of capital is extremely important to trade. So I don't mind if I'm making, say, 8 to 10% dividends, and I know that even if the worst case scenario I will lose 8 to 10% in some, whether it's an option or trading idea or something that could happen, my portfolio still will remain for a year on pretty well the same level. Of course, I'm trying to limit my exposure to forgo my dividends. I hate even to think about this idea. So I'm trying to be very careful. So now I would be open to the idea, listening to you, to consider a small part of the portfolio to devote to
Microcap.
high growth microcap stocks. Am I right in thinking about the strategy? What do you think?
Well, I mean, anybody that wants to get involved in this microcap space, whether it's to have a small allocation of portfolio or bigger allocation, there's a few things that they should keep in mind. One is that the traditional products like options or technical analysis is probably not going to work very well in that space because those names have much lower liquidity. And for some people, liquidity is very important. For others, lack of liquidity can present an opportunity because it keeps others away. But the lack of liquidity also creates more volatility. So many times, I always tell this example. I bought a stock, I took a nap. By the time I woke up from the nap, I'm down 30% because somebody decides to sell a bunch of shares all at once. And so you have to have a stomach for volatility, and you have to realize that, hey, you have to know what you own, because you can borrow someone else's idea, but you cannot borrow someone else's conviction in that idea. So these, for anybody that would want to get involved, I would say, like, just keep these things in perspective, keep them in mind, because just because I say something is going to, do 10x doesn't mean it's not going to decline 40% before it does 10x.
Yeah, it's very interesting what you said about conviction. I remember my younger days. I wish I would be 35 years younger, because
Mhm.
at that time when I started my first investment, and it was very, very successful, number one, I had no fear. Number two, I had no knowledge whatsoever. Number three, I had a lot of conviction in that stock that I bought. So all
That could be
three,
dangerous.
Peter, it's more than enough. What else do you need? So you have, at that time, actually, I had available probably $25,000, $30,000. That's all what I had. So I had a perfect combination. And it became a very successful investment. Today, when I have many, many, many times more than that, uh, but I lost a lot of other qualities. I think I have to train myself a little bit to become eligible for microcap investing again.
Yeah, it's a very interesting area. I mean, I'm really fascinated by what you're saying, Maris. What's your average holding period for stocks? I know that this is a very approximate thing, but yeah, what's how many years would you say on average? Because you're only saying you're holding about maybe two or three stocks a year. How long do you usually hold them? Like a couple of years, or?
Well, right now I hold about 8, but
Oh, that's a
really,
lot.
really, the top 3 are so big in relation to the other names that it's not even, doesn't even matter what happens to the other names. But I would say, I mean, in order to be successful in this strategy, I would say you have to be able to sit on your butt and do nothing for
Hmm.
years. And I am very good at sitting on my butt and doing nothing. And this could be good and this could be bad, because if you are in bad situations and you have too much patience, that's bad. but you
Right.
need that patience to be successful. So it's this balancing act. And I always tell people, look, with some of these things, you have to have unlimited patience, but at the same time, you need to know why you own it. And yeah, but I would say, 4 or 5 years, it's the norm.
Oh, wow. So you may hold 4 or 5 years. Yeah, you're right. It takes patience, and you have to be able to just ride it out then, you're saying. Now, when you say you have 8 positions, so if somebody joined your group, they would be able to see those 8 positions. Is that it?
Yes, yes. So we
And do
have
you
we
show
have
them,
a
do you show
yeah.
them the allocations, like the suggested allocations?
They do know that my top 3 positions, what they are. I don't tell them exactly the allocation because I don't want people just to blindly copy me. I have a
Oh, I would have
hired,
thought the opposite. If
yeah.
I went into your group, and maybe I'll even consider it, I would want to know, do you think this, risk reward ratio is worth 2% of your portfolio relative to maybe your big ones that are worth 25, or do you think it's worth 10 or 15? Because it gives you a relative size. So you're saying, you just say, these are my 3 big ones, these are my 5 little ones, but I don't, have any
I mean, I
relative.
don't mind. I don't mind if someone emails me. I'll say it to them. Like I
Oh,
don't. I
okay.
don't hide it. I just don't want somebody new to be like, oh look, he's got such a big position on this one. I'm gonna take a home equity line on my home and just
Oh,
bet
I
it the
see what
same
you're
way.
saying.
I just want to protect them, and I want people to make their own decisions based on their own financial situation,
Oh,
their
yeah,
own
that's
risk
good
profile.
for
But I
yeah.
don't hide it. I just don't show
Right.
it
So
to
if somebody
protect them.
wanted to know how
Yeah.
you felt, like you'd say, "Oh, I'm in 20% here, 10," just, to have an idea, although you could change your mind and they might not know you changed. But since you're holding for 4 or 5 years, it probably stays pretty steady, you know,
Yeah,
these
but
situations.
then sometimes you might, let's say I want to trim something a
Mhm.
little bit. It might freak some people out. Why did he trim this? Is something wrong with the one that he trimmed? And it's like, no, no, because I needed money for to
Oh,
add a little bit here.
right.
So
Do you tell people when you trim?
I don't trim very often, but
But if you did trim,
when
would
I
you tell
do,
people or not necessarily?
not necessarily.
Oh,
Uh,
okay.
but if I were to, sell out of a position, of
Oh,
course, I
yeah,
would
yeah.
say. But if I trim a little bit, I don't usually
Yeah, it's
say
just
it because,
an
yeah,
adjustment in the
yeah,
portfolio allocation. Right.
yeah,
Peter, you see, with this, you have to throw away everything what you are doing while conventional investing, for example, like managing your risk. Let's say I have a strategy that if I lose 7%, up to 7%
Mhm.
of any single position, I'm out. I sell
So
position.
that's your rule, yeah.
No second guessing, not 7.5%, 8%. It's not going to happen. 7%, that's a max. Okay. Now, so this, yes, the stock may go a little bit more down and then it will recover. Then you might even forgo your profits, but you can always buy it back, even next day or a week later when you see that the downturn is
Well,
completed.
yeah, you wouldn't be able to do that with microcap stocks
no,
because
no, you,
Exactly.
no, you would
you'd be
get.
in
Exactly.
and out all day.
I
But
Impossible.
mean,
yeah, that's your
we
point. Yeah.
we go up and down 10 to 20% within minutes sometimes.
Wow.
I mean,
Exactly.
yeah, you would
Wow.
get shaken out of your position. That's why it's so important to know exactly why you own it, because it's tough to have those rules. 10% stop. Trigger points. It's tough to do it on these.
Yeah, no, you know what this reminds me of? The mortgage situation. Now, I don't even remember the author, but he uh he took a bet. He wrote books about it, and he had seen the mortgage crisis coming, like, and for years and years he waited because he believed.
Michael Burry, right?
Yes, yes,
Yeah.
thank you. And he waited very patiently for years and kept wondering what was going on. Why isn't this collapsing? And then he made a fortune. Because all these leveraged positions came through for him in the end when the mortgage market collapsed. So it reminds me a little bit of that. You just need the patience, and you need to believe and have a lot of conviction. In this, what you're saying, but it sounds really interesting again. Go ahead, Sasha.
Peter, practically speaking, I think, let's see if I have let's say $1 million portfolio, and I would put 5 to 10% I would say 5% more likely, because I would still have another 5% to do option trades or something like that. But let's see if I don't want to do options anymore. So I'll put 10%. So that means that you're taking $100,000. You try to diversify in five, better even 10 positions, and just forget about this part of your portfolio for years. You
Oh,
can
yeah.
monitor it maybe once a month, just from curiosity what's happening there. But that's about it. You cannot trade it. You cannot unload it.
Right.
So on. And even if, let's see, if there is a profit, let's say you can unload it to make, say, 25% profit, it's not enough,
Yeah.
because the risk what you're taking is far more than that. So you have
Right.
to make at least 100% profit, bet, even better, 150 to 200%,
Yeah.
even before thinking about unloading that, because the risk you're taking is still enormous, and not
Yeah.
something
No, it's
wrong.
definitely, even though you've had tremendous success,
Liquidity, it's a
you never know.
spread between bid and ask, and somebody's selling because of somebody got frustrated or whatever, lost his conviction, whatever it might be, or got divorced, or who knows.
Right.
So you really, you have to aim for minimum 100% profit, better 150 to 200. You have to forget about this for at least a year, maybe even longer.
No, I think much longer. I think you have to have a time frame that you're look, because these things take years to ferment. So you really have to have the mentality that I'm putting this money aside. I'm going to stay with the portfolio unless there's changes in the portfolio. And
Well, there
you know,
could be a special situation. Let's see if it's a high tech project, and let's see if a major company is buying it, then the stock can be like quadruple or maybe even 1,000 times more in a short period. Well, that's a
well, that's the point. Exactly. That's why. Yeah, exactly. That's why I put a little bit into DWAC as the side,
Hmm.
the Trump thing, because I figured I think it has the potential to be like a Google, and but I put in 1/3 of 1% because saw the risk reward. If I lose 1/3 of 1% with all my dividends income, it's not going to really change my life. But I think in 10 years it could be a you know big. It could be as big as Facebook or Google easily. So it could go either way, but it's a risky situation. But I have a feeling Marius's situations are, because that was well known. Marius can dig deeper into the situations that most people don't even see, and so that's even more interesting in a lot of
Well,
ways.
for me, I guess I define the risk a little bit differently than what Sasha was saying, because the volatility up and down, I don't assign any risk to it because I don't care. What I
Right,
do care about is what the business is doing. That's
right.
where I spend so much time on the phone, making sure that I cannot get killed there. Because
I
if I'm
like that.
down 50%, but the business is still okay, then it's just me having the stomach. Uh, so
Exactly. You know
yeah.
what? Let me give an analogy to, because I've said this before, but this is how I look at the market in general when I buy a company. I say, if let's say I bought a dry cleaner or I bought a car wash or some kind of business, I'm not going out there every day and saying, oh, it went down 20%, it went up 20%. Somebody wants to buy for more, somebody wants to buy less. I want to buy a stream of income, or in your case, a stream of growth, and just stay with it.
Do you guys have you guys heard the analogy of Mr. Market that Warren Buffett coined?
What? No, go ahead.
Okay, so he talks about that people should think of stocks as businesses, not just ticker
Right.
symbols.
What I
And
was just saying.
so with your example of did you say dry cleaners?
Yeah, I just picked
Yeah.
dry
So
cleaner,
so
car
so with
wash,
your example of,
any
let's say,
business.
we all own or you and me together, we own dry cleaners, okay, and then we have a third partner called Mr. Market. And Mr. Market comes to our door every day, every morning, knocks on our door, and he either offers to buy our interest in the
Very
business
good.
or sell his interest to us. But
Right.
Mr. Market is manic depressive and
Yeah.
very emotional, and he's an alcoholic at the same time. So
Oh, that's
for
great.
us as logical business owners, what we should do is ignore Mr. Market and only take him up on his offer, whether to buy or sell, when it's convenient for us. but we shouldn't take
Right.
directions from Mr. Market as to, because Mr. Market watches the news and
That's
watches what
great.
the Fed is doing and sometimes says, oh, the Fed is going to raise or lower interest rates, therefore your business is worth more or less. We just have to sit back and be like, Mr. Market, thank you very much for your opinion. Have a beer and come back tomorrow.
Yes, that's great. You know what? I would even add to that the way you told the story. I was thinking, if Mr. Market is coming to my door every day, I would say, stop coming to my door. I don't even want to talk to you. Because you know what? I have my business. I want to hold it. I don't want anything to do with this guy because he's manic depressive and he's crazy.
Yeah.
Well, also that's if you look at corporations and you do valuations on corporations, you look at stock as a corporation, and then you're doing valuations on. So that's a whole different cat. And the market, I agree, the market does not really do proper valuations.
Oh no.
Which, Murray, since you work in the small cap, I missed the party because unfortunately I do own a fairly sized pension company back in Utah that manages about 500 million in assets. And
Wow.
every now and then I get phone calls, ring, da 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 needs to be done from the president of the company. I don't manage it anymore. I managed it for about 10 years, 15 years maybe. I don't even want to count. But okay, so I missed the great story about how you were taking next to nothing and ratcheting it up to 6 million in investing. You know, so I think there's certainly I want to hear that great story again. Sorry that I missed it. But the thing is on the large cap or small caps, do you actually do a valuation analysis on the corporation going to invest in?
Well, of course, I want to know what I'm getting for my money, but with the smaller companies, it's a little bit different because the financial industry likes to divide the opportunities into growth stocks or value stocks, and when you look at the discounted cash flow analysis, well, the growth is one of the variable in valuation. So I kind of find it funny, be like, why are we even dividing it? Because so when I'm looking at smaller companies, um, I might not just look at it and say, what is it worth today? I want to know what I want to know what creates revenues. I want to know why the customers are buying the product, and I want to know what the revenues can be down the road. And then based on those revenues down the road, what is it going to be worth then? Because if I only look at the value today, I would miss out most of the opportunities. Um,
Okay, well, I know you work in the small cap market, so I'm gonna throw you a curve. This is something that comes up on our show all the time. Tesla. Okay, I had a real problem with Tesla is that we're looking at these price earnings ratios of like 300 to 1. I mean, it's incredible. If I had that price earnings ratio in my company that Elon Musk did, I would be an extremely wealthy person. Okay, but Elon Musk gets these unbelievable PE ratios. How do you explain, or how would anybody in their right mind invest in a company like Tesla with these high PE ratios? Or do you ever invest in small cap stocks or micro stocks with high PE ratios? Just
well,
me and this
yeah.
panel, we have a little bit of a problem with it.
Well, first of all, just because you, just because everybody in this room now knows about Tesla, I would immediately be not interested. If
Mhm.
if
Perfect.
my neighbor down the street heard about it, it's like, okay, it's probably too much competition there for me. Like I can do better. But you see, the PE ratios can be misleading because let's for example, I just on my YouTube channel I gave this example of can we all picture a 10 unit apartment building? Okay, we just built it and it only has two tenants. Okay, when you look at the financials, uh, you would look at it and say, "Oh my goodness, this is terrible. The property is losing money. Uh, it has negative net income. How could I possibly buy it?" But if let's say the owner said, "You know what? I just built this apartment building. It only has two tenants. You can lease out the other eight, but I'm getting a divorce. I have to sell it. I can sell it to you for $50,000, and it costs me 800 to build it, and if it's fully occupied, it's going to be worth $1.5 million. If you're just looking at it from the PE point of view, you would be like, no, I would never buy it for 50,000 because it's losing money. But this would be a huge mistake because you could take this building and you can fill out the rest of the units and you would just have a 20x. So it's kind of difficult to say what is the right PE ratio or what is the right revenue multiple. It's really difficult. That's where understanding of the business comes into
Right.
play, because
Exactly. The
what is the
fundamentals of the
yeah,
business.
what is the cost structure? Do
Yeah.
they have any operating leverage? Did they already build out the infrastructure, and does it cost them a lot to add new clients, or it's just too it's hard to just have. I always say, don't have rule of thumbs. The rule of thumbs should be, why don't you learn the business? And then once you understand how the business operates, how they get revenues, what is the relationship between variable costs and fixed costs, then you might have some kind of educated opinions that you can form. And then maybe 100 PE is cheap if you know that the revenues are going to grow, but the expenses are not going to grow, and then the PE
Sure.
or the net income is going to catch up to it. It's just much more to it than just having a particular number in your head.
Marius,
I,
I have a question.
Yeah.
Uh, um, so do you make all the decisions personally, or is there other staff, or basically you lead the whole group?
Well, I make the decisions as to what I want to invest in,
Okay.
and what I want to write about, and then each member decides on their own if they believe in the
Oh, of
story.
course, yeah.
But yeah, I mean, and we do have a section. We have a forum on our website where other members, you know, share their own ideas with other people. But that's like a subsector of the website. Whatever
Is it
is
public, or are you willing to say how many members you have right now? Is that public, or is that
we
something
have
you
about
can-
we have about 300 members.
Oh, okay, very good. Yeah, very good.
yeah.
Sasha, I think we
What I
might be
want,
running out of time, but go ahead.
yeah, Peter, what I wanted to mention about the PE business, that it's basically backward looking statement. Whenever you're analyzing price per earning ratio, you're talking about what's been done in the past. It has nothing to do with the future whatsoever,
Sure.
because it can go skyrocket up,
Right.
and it can go downwards big time. So with the PE, and also, like, I'm almost
I
ready to
agree.
dismiss that, because every person, there are tens of millions investors who knows that with a touch of a button, okay, the PE of this company is say 12, and this company is 17, and this company is 23. Okay, so now you just announced what everybody on the street knows already.
Exactly what
So
Marius was saying. Yeah.
what's the point? What even the point?
Yeah,
Of
you know what? And by the way, I never. It's funny. I never looked at PEs. I haven't looked at a PE probably more than once or twice in 10 years. I look at the first thing I start with is cash flow, because as Marius says, I'm trying to understand the business. And if you look at the cash coming in, the cash coming out, what they're using the cash for, that tells you a lot more than the ratio of the PE, especially because the PE often assume, you may have depreciation in there, you may have taxes that are, variable, you could have all kind of things, one-time events in the PE. So you really have to track the cash flow, or you
Right.
could have a huge growth situation, or a situation like the apartments Marius was saying. So yeah, PE it's old hat, I think, and a lot of people realize that, but a lot of people don't.
Well,
I think it's one factor. In other words, the thing is, you got to look at a lot of factors, and PE is just one factor that you look at. But no, you can't put
I
all
don't
your.
even look at that.
Well, I like to look at fundamentals. That's the reason,
Yeah,
and
exactly.
where the economy is going. That's the reason I loaded up on Pfizer and BMY, because I think Pfizer is going to be the dominant player in the pharmaceutical market.
Yeah,
I made a lot of money, then I bailed out, and I realized, hey, this stuff isn't going to go away. They're going to make more money. So I went back into Pfizer, and BMY was down, which is Bristol Myers Squibb, was down 11% based on the law change that they're going to start regulating pharmaceuticals, which is part of the 1.75 billion infrastructure.
I know that's my fear of the
I'm,
pharma industry.
it is, but I'm betting against it. I'm betting on Joe Manchin, not Joe Biden. But I
Right.
think everybody's got to take their bets. In the micro stocks, I don't do anything at all, because the thing is, because unfortunately you have to be like Maurice, you have to know a lot of information to make a decision.
Right.
And if you decide wrong, you can get your rear handed to you. But it sounds like you did the work, Maurice, right?
Oh, yeah.
Yeah, but didn't you say, Nick,
Yeah.
that with the company
Sure.
that you're with, you're managing a large sum of money,
Yeah.
right?
Yeah,
I mean, it doesn't make sense for you with
okay.
this. You know?
Yeah, well, the thing is, see, in our industry, we're in pensions. Okay, so we're managing pension money that are in fully insured plans. So we're limited to our investments. We only have two types. You can buy a fixed or equity index annuity from a life insurance company or whole life product from insurance company. End of investments. Now, on the 401k profit sharing side, then it's usually a platform of all these mutual funds that people get into. But because we're so highly regulated, there are things that the only way they can do things like that you're doing is they would have to have like SIDRAs, what they call self-directed IRAs, or self-directed investment platforms, which there's another attorney I know that specializes in that area, but that's not my industry for the last 20 years. Last 20
Right.
years
Oh,
I've been
this
doing
has
is
been
with pensions.
fascinating, Sasha. I think we're gonna
Yeah.
have to
Oh
end
no,
the
I,
show
I,
there.
I think it's great. It brings a whole new dynamic,
Absolutely.
and I hope our friends that we rebroadcast to, and Al Jazeera and the BBC network, like this stuff.
Yeah.
So no, I think it's great that we're able to bring it to. Yeah. Just realize that this is broadcast internationally. So but the good news about the market, as we know, Peter, they invest in U.S. stuff just like it was next
Oh,
door.
of course. Yeah. No,
And they
Good
follow.
thing about the
it's a
market
major market.
is,
If everybody could stay on after the call, by the way,
yeah.
I want to talk to people.
Okay,
Sure.
thank you very much for the wonderful program today, and I hope we'll have another one a week from today, next Wednesday, and it will be our last program for 2021. Thank you very much. Goodbye. Bye-bye.